If you're a value investor today, your returns are probably not as good as the overall market. In fact, you might even be losing money. But what if you're a growth investor? Are the continued gains sustainable? Did you just get lucky? Or is value investing dead? To answer these questions, let's jump straight into the video. So what is value investing? On Investopedia, it is defined as an investment strategy that involves picking stocks that appear to be trading for less than their intrinsic value or book value. And for those that don't know, intrinsic value is a measure of what an asset is worth today, taking into account estimates into the future. And book value is a measure based only on the present time. For the past few decades, investing in value stocks that are undervalued compared to their future worth often delivered strong outperformance. However, in the past few years, compared to many growth/tech stocks, value portfolios have underperformed. If we look at the Wilshire Growth and Value Indices, it charts both the US growth and value indices in large, mid, and small caps. We'll see that both growth and value yield similar returns up until the end of 2017, with large cap growth leading, followed by large cap value. This follows all the way through to the peak of COVID during March 2020. And now this is where it gets interesting. If we look at how the indices are performing today, we'll see that the growth indices have occupied the top 3 positions and completely taken over the value indices. And that's it, the value era is over. End of video. Okay, just kidding. Let's think a little.
Yeah, they had us the first half, I'm not gonna lie.
Many value investors begin with Benjamin Graham's focus on companies with a low price book ratio. These are cigar butt companies that are considered bargains because they have a low price compared to their book value. This kind of value investing isn't so relevant anymore because the traditional book value ratios exclude many of the resources that are most important to companies today. Why would you buy a company just because it's cheap? So what? Just because it's cheap, it doesn't mean it's going to perform well in the future. Charlie Munger persuaded Buffett to step away from cheap options and look for value in the company as a whole. This mindset shift then became the foundation for the saying, "Don't buy fair companies at a good price, buy good companies at a fair price." Past performance is no guarantee of future results, and what worked well in the past may not work in the future. They patched this in the Corona update. Growth stocks are the complete opposite. They have a high PE ratio and high book value ratio, and are expected to grow substantially in the future. Investors expect profits to be significantly higher in the future compared to the current. These are often tech stocks that can exert greater monopolistic power and take an increasingly higher share of profits. Compared to the tech and dot-com bubble, today's tech companies justify their valuations because they are simply better companies with more innovation and scalable business models. Technology has just grown so rapidly that they have much better earning profiles in markets that still have significant structural tailwinds. Another factor to consider is that company profits are no longer as relevant because of quantitative easing. Printing trillions of dollars causes inflation and adds a ton of demand for stocks, making it the new casino. This means stock prices no longer reflect value, profits, or other underlying economic fundamentals, but rather are simply a function of how much money the Fed can print. While value stocks are experiencing unprecedented levels of cheapness relative to growth stocks, fundamental stock picking becomes a bit more complicated. Intangibles such as intellectual property need to be taken into account for, and value traps need to be avoided. For a value investor, in order to make money, the market must begin to agree for the price convergence to happen. And currently, with a disparity between price and real value, it's going to take some time before that happens. If you're a value investor, buying with a margin of safety relative to the estimated value and deeply assessing the potential investment is more important than ever before. But the bottom line is that markets are cyclical and value investing has its place. It is one of the most successful strategies for investing in the share market and is used by some of the best investors in the world. Growth and value are almost indistinguishable. They're two sides of the same coin. To be more precise, growth is part of the value equation, and they're not exactly two contrasting asset classes. After all, if you're a growth investor, you're still trying to identify good, solid businesses that are trading below their fair value today. You're still ensuring that the company has sound business operations that will grow the company. And you're still valuing the business's ability to grow and increase cash flow. There's no reason why you can't have some value and some growth. There's nothing wrong with using value investing principles in combination with other investment strategies. Risk versus reward is a different calculation for different people. Value investing is just one of many strategies you can try out and see if it fits with your own investing temperament. At the end of the day, finding great businesses and buying them at margin of safety prices will always be one of the best long-term investment strategies. All in on Tesla.